My name is Jake, welcome to the channel. In today's video, I want to talk about how to sell cash secured puts for income. If you watched my video last week, I explained, just the basics around cash secured puts and cover calls, generating income from selling options. Now, the thing that I love about selling options is you have the potential for a higher yield with a lower amount of money. Now, the difference is with dividend investing, if you want a higher yield, you generally have to take a little bit more risk. Maybe you invest into sin stocks, maybe tobacco companies to get a higher yield, but you're maybe sacrificing on the growth side. Now, with selling options, you have the potential to generate a higher yield without taking on a little bit more risk, in my opinion. So in my video last week, it was more so on the educational side, just kind of helping you understand what cash secure puts are and cover calls. So I'm going to show you how I do it. It's not perfect. It works for me. I've watched hundreds of hours on YouTube, on this topic and what other people do. And I've kind of taken what I've seen other people do and I've kind of molded it into my own way of doing it. And I'm sure that there's many other ways that you could do what I'm talking about or what I'm going to show you in this video. But this is what works for me. This is kind of a simple approach of how I've been able to do it. And I'm sure that there's going to be some arrogant noob in the comments saying that I'm doing it wrong or that they could do it better. And it might look a little like this.
People don't know this, but this is actually the right way to eat a cinnamon roll. We start by unraveling it from the center and...
That is not the correct way to eat a cinnamon roll. That is not the way you're supposed to do it. That is some false ass information about the cinnamon roll, and I don't appreciate it. You're gonna have all these goofy ass children walking around eating the cinnamon rolls the wrong way. That is not correct information. You're supposed to eat the cinnamon roll like that. What the hell wrong with you?
Oh my gosh. Oh man, cinnamon. That's probably what I sound like in my videos. Oh my gosh. Oh man. All right, now let's talk about how to sell cash secure puts for income. So I'm going to walk you through pretty high level some things that I do, and I want to share with you some things that I would recommend if you were starting to do this. And I'm going to share some of the things that have really helped me, and then I'm going to dive in and give a few examples. The very first thing when you're selling cash secure puts, you want to have a list of 5 to 10 to 15 individual stocks that you would feel comfortable owning if you ended up being assigned the shares. Let's say at expiration, they were below your strike price and you were forced to buy them. You have to be comfortable and willing to hold these stocks if you were to get assigned. If something happens like in 2022 and the market craps itself, you have to be able to stomach that and be able to hold the shares and not emotionally sell them at a loss. Okay, so the first thing you're going to do is you're going to want to create a list of 5 to 15 stocks, and you're going to want to use a criteria that fits for you. For me personally, the thing that I prioritize is I want to be able to understand the stocks. I focus on growth stocks, like mostly software tech stocks. I worked in the tech sector, so I kind of understand that. If you work in healthcare or something else, find stocks that you're familiar with and you're comfortable with. But something that I really focus on is I want to make sure that the company has more cash on hand than total debt, if possible. That's a huge criteria for me, is I want to make sure that they're, especially with higher interest rates, that they're going to be able to service their debts should they be, come callable in the future, when their debts mature. So cash on hand is really, really important to me. I also really like institutional ownership. I want to make sure that there's institutions involved. Usually if there's an institution involved, they do their research. Institutions invest into companies that, they spend a lot of money on research, and if they're doing it, then that's a good sign for me. The next thing that I like to look at is debt to equity, right? A lot of this with higher interest rates, companies with a high amount of debt, low cash are going to get crushed. And then the last thing is, in most cases, I like to see that they're already profitable, right? That they are not losing tons and tons of money. So in most cases, that's really, really what I'm looking for. And so that's the list that I created. And then in Seeking Alpha, you can create your list here and you can see which stocks meet your criteria and you can add them here. And then another thing that I like to do, now everyone likes to do this, there's pros and cons to this, is when I'm selling cash secure puts, it's all about volatility, right? And so what I like doing is I like sometimes taking advantage when I'm selling cash secure puts. With covered calls, this is a little bit riskier. You have a higher chance of them getting assigned. But when you're selling cash secure puts, I really like taking advantage of the volatility around earning dates, earning releases. And so, for example, let's say I'm interested in, Workday. Just normally Workday trades has very low volatility, but around their earnings date, their volatility spikes up a bit, so you can take advantage of that. But generally, if you do this, you want to be more conservative on the strike price and have it lower than where it's currently trading. You want to generally give yourself a good buffer. And what I like to do is I like to give a buffer of about 20%. That's generally where I come in. So if a stock is trading, let's say at $175, I generally will look at, seeing, okay, well, around the earnings date, a couple of weeks after, can I see if I can get it around 140, 130, somewhere around there, to give myself a little bit of buffer. Like I said, some people are going to say, no, don't do this. Other people are going to be like, well, okay. No, what I've noticed for the stocks that I'm looking at, they're generally, this is the creme de la creme. These are the best software companies in the world in many cases. So there's usually not a lot of volatility generally. And that's why I tend to like trading around or selling around the earnings date. But maybe to begin with, maybe you don't do that. But that's just generally, that's a personal opinion. The next thing that I look at is the fear and greed index. You can see where the market as a whole is. And you can see here currently today that it is, extremely greedy, right? Now, it's not the best time to sell cash secured puts because the premiums will be lower. Now, on the flip side, this is a great time to sell covered calls. Okay, this is a great time to sell covered calls. When the market is in extreme fear, that's the best time to sell cash secured puts. Okay, so regardless of where the market is at, if you own shares, you can sell covered calls and take advantage of the volatility, okay, and how the market is moving. So just be aware that when the market is in extreme greed, it's very difficult to sell cash secured puts and get a good premium, okay? So just be mindful of that. The next thing that I like to do when I'm looking at which stocks to include, right, in my list is I like to understand, well, what are analysts saying about this stock? And what I like to do is I like to go over to Benzinga. It's a free resource. It's a free website, no affiliation. I like to go over and see, okay, well, what are analysts who are tracking this company saying about the stock? And you can see the date in which when they're saying it. You can see the analyst firm, UBS, Goldman Sachs, and you can see here, what their price target is for the stock based off of when the analysts made the prediction or the price estimate. All right, the last thing that I look at here, before I'm selling a cash secure put is I kind of look at the chart just generally. I'm not the best at this, but something that I do is I look at the relative strength index. I see where the stock is trading. Is it, has it spiked up? Obviously, you don't really want to sell a cash secured put if the stock just went up 20% in the last week. So you kind of want to understand where has the stock traded historically. And, if there's a big market event like an earnings release, that could change, right? So for example, Atlassian was trading at over 250, and then right after earnings, they had a disappointing earnings release, and so the stock went way down. And so that's something that I look at. I look at, the moving averages a little bit, the 50-day and the 20, but the thing that I really like to look at is the Bollinger Band. That's what you're seeing here in the blue here, and you can see kind of generally where the stock is trading. And I would encourage you, if you're interested in this, to go and research on the Bollinger Bands, understand moving averages, the 50-day and the 200-day, understand RSIs, take a look at that, and just kind of generally just understand what you're looking at. But you see here in the light blue, that's the Bollinger Band, and that's where the stock generally would trade or has traded historically. And you can see here, this little blue line is the 200-day average. So if the market were to tank, this is probably about where the stock would revert down to. That's why these moving averages are important. It's not to talk about the fundamentals. It's just kind of how the stock has traded or how it has reacted to the market and what the historical norms have been, give or take. Okay. The green line is the stock price itself. So what I like to do generally is the stock price on the lower end of the Bollinger Band. And if it's around here, I generally will say, you know what, I'm fine, writing or selling a cash secure put at that time. What I don't like to do is sell a cash secure put when the price is on the higher end of the Bollinger Band, because the premium's not going to be very good. I generally will write it about 20% lower. So if the stock is at $100, I generally will try to sell it at $80. And so the premiums are just not very good. And so the moral of the story here is, if you're serious about this, is understand how the stock kind of moves, and understand, okay, well, if you were to write a cash secure put and you don't want to get assigned, well, it's very possible, depending on the stock, that you're going to want to look at the chart and you're going to see, okay, well, the stock has historically not gone below this level. I'm comfortable with selling a cash secure put at this level. Now, obviously, the market could completely tank because Jerome Powell raises interest rates, right? And it could go the complete different direction. No one knows. What it really comes down to is just looking at how the share price has performed, what are the historical averages, and where you would be comfortable owning shares of the company if you were assigned. Okay, now let me share some examples of how I've done this and some things that I kind of look at, and give you a real life example of some options that I sold this week. So let's look here at the very top here. You can see that I sold a cash secured put on Etsy. And I did this, I think 2 days ago. I sold it on Etsy. So Etsy is going to be reporting earnings here on the 21st. So I was thinking, you know what? I'm comfortable holding Etsy. Let's see if we can find any options that are, that make sense. So Etsy's going to be, reporting earnings here on the 21st. What I looked at is say, okay, well, I would be interested in buying Etsy, but I don't want to buy it at this price. So let me sell a cash secured put, something that expires after the earnings date, so I can take advantage of the volatility. And the volatility on this one is actually pretty high. It's about 70% volatility. And when I sold this on February 7th, and I sold 5 contracts. So one contract is 100 shares, and I sold it for 49 cents a contract. And with these 5 contracts, I generated $245 in premiums today. So essentially what I'm saying is, okay, after earnings on March 8th, I am willing to purchase 5 contracts or 500 shares of Etsy for $57. Where's Etsy today? Etsy is at almost $78. And generally, I like to purchase something below 80%. And so today, right now, if it's at $78, 80% would be $62. So I was able to get this well below my 20% threshold, my target threshold of what I like. And because the shares have gone up since I wrote this, contract, now I could have done the reverse, right? I don't have a magic ball, but it's now over 25% below my strike price. So I'm feeling very comfortable about this one. I didn't, this was not a very risky one. This was, 20% below the strike price. I'm comfortable owning the shares. I got a decent, premium. I'm happy with the premium. If I were to have to buy the shares at $57, let's see, where's Etsy at right now? Take a look at over the last 5 years. Over the last year, Etsy, in the last year, it's gone down to $60. So if I were able to get this at $57. So the great thing about this that I really like is I'm comfortable buying shares of this company anyways, but I'm willing to buy it at $57. It's not been $57 in how many years? It's not been $57 since the pandemic in 2020. So I'm very, very comfortable with owning shares of Etsy at $57. Let me show you another example of one that I did here 2 days ago is with Twilio. Twilio is on my list of stocks that I would be comfortable owning. I used to work at a competitor of Twilio. I know the space fairly well. The company is, in a difficult industry, but it's one that I would be comfortable owning. I sold a cash secured put on Twilio 2 days ago. You can see here that the implied volatility is it's pretty high. It's not, 100 plus, but it's pretty high. But really quick, before I forget, this video is not meant to be, a deep dive to help you understand everything. What I'm trying to help you understand is kind of how I do it. And then my goal for this is for you to then kind of see what I'm saying and then to go and learn more about different areas that you're interested in. But something that you'll definitely want to understand, and I haven't talked about this yet, this is pretty important, is the Greeks. Now, this can be a little bit confusing in the beginning, but there's really two of them. There's two that I focus on. The first one is on the delta. The delta is the likelihood of getting assigned at expiration. Okay, so if the delta is low, then you have a lower probability of getting assigned. If this delta was like 30, 40, 50, then yeah, it's very likely that I'm going to get assigned at expiration. And the expiration is, where's the expiration? Expiration is right here, okay? March 15th. But the delta is very, very low on this one. So when looking at the Greeks, that's the first thing that I look at is the delta. What is the likelihood of getting assigned? The next one that I look at is theta. Now, theta is really important, especially if you're going to have an option that expires months or maybe even years in the future. If the theta is high, that means that the contract price will go up or down faster. If the theta is low, that means you're going to have very, very low, volatility, very low fluctuation in the contract price. Now, this can be a good thing or a bad thing. It really depends on you and your personal preference. I personally like a higher theta, especially when I'm selling around earnings releases, that the options contract is going to move quicker. And I actually like that because what can happen is if the theta is high, the price of the contract can go dramatically down months before the contract expires, and then you can buy back the contract and sell something else. You can realize the gain much quicker if, assuming that the share, especially in a bull market. This works very, very well in a bull market. In a bear market, it can work, against you, okay? So just be mindful of that. This can work for or against you. I like seeing a theta a little bit higher because, time is money, and the quicker the options are moving, are decaying, that means that I can realize the premium sooner and then move on to the next one. Okay, that's kind of how I view it. Not everybody's going to view it that way. And so you're seeing here, if you would have sold, this $55 put for March 15th back in December, it would have been valued at $1. Today, it's valued at 52 cents. Okay. And so if you look over the week here, you can see that, because the theta is a little bit higher and it's getting closer to expiration and closer to their earnings release here next week, you're seeing that there's a little bit more fluctuation in the contract price. And let's say, for example, they're releasing their earnings next week. Let's say hypothetically they do very well and their share price goes up. Well, then what you could see is you'll see that this options contract price go down significantly after their earnings. Now, on the flip side, if they report poor earnings, this will spike up. It'll go way up. Okay. And so it can work for you or against you. Okay. And so it's just really, really important to understand that if they were to report poor earnings, it's very, very likely that I will have to hold this to expiration. But here's the kicker. If they report positive earnings, it's very, very possible that I'm able to buy this option back and realize the gain, next week, instead of having to hold it until March 15th. And this is what's really cool is if they did have a positive earnings report, my 900 shares or my 9 contracts, which are currently holding up $49,500, I would be able to release the collateral and then sell another option on another stock. Okay, so that's how that can work. And that's how I'm able to, kind of turn these over, realize the premium, the majority of the premium, and then flip them into something else. Okay. Now that might be a little bit confusing. You might not fully understand that. I'm not going to dive too much deeper into that into this video. And I know that this can be a very complicated topic. You can go and you can watch other YouTube videos to try to help you understand it more. If you just want to talk to somebody and, ask questions and, you learn better by having one-on-one interaction, I did set up a website where you can you can book time directly with me. We can talk about dividend investing, or I also added a service, option selling for income. If you want to learn more about selling cash secure puts and you just want somebody to talk to, I set this up and you can book time directly with me. So that's the example with Twilio. So once again, I did it around the earnings date. That's not something that you have to do. I personally like doing it because I can take advantage of the elevated volatility. When it's not around the earnings date, the volatility is probably going to be in the 30s, maybe in the 40s. So significantly lower, but also the option premium is going to be lower. So that's something to be mindful of. All right, lastly here, I want to give you an example of how I would approach selling a cover call on a company like Atlassian. I've been selling cover calls on Atlassian for the last about year and a half. I've done very well on this stock. Now, it could be because it was in a bull market. Now, obviously, I want to be fair, and let's say I started doing this in 2022. I would have gotten destroyed very likely. In a bull market, everything works. In a bear market, it can be very, very difficult. So, but me personally, I like Atlassian. It's a good one to consider. I'm not saying, this is right for you, but this is what I look at when I'm considering selling cover calls on a stock. So first off, what I want to do is I want to take a look at their options chain. And with Robinhood, they make it very, very simple. And because I'm selling, what I'm going to do is I'm going to go over here to the sell tab and I'm going to go to puts. So I am selling a cash secured put. And because Atlassian just had their earnings release here, I believe last week, we can expect that the volatility is probably going to be a little bit lower. But generally what I like to do is I like to sell options, 30 to 60 days. Sometimes I'll do 90 days, but generally I like to do it 30 to 60 days. And it's usually better to do it the second or third Friday of the month. That's generally where you're going to see the most volume, therefore the most premiums in most cases. But the strike prices are going to vary depending on which week or month you select. Okay, so let's take a look at example for March 15th. Now, this is just an example. I'm not doing this today right now. I've already wrote all my options for the week, for the month. So if I were to sell something, I could consider doing this, but this is not something I'm doing right this second. But what I would look at is see, okay, well, first off, what I want to start with is I want to use the example again of 20% below. So is it $220? If I'm doing it in 30-ish days, I want to make sure that it's at least 20% below where I'm at today. And so I feel fairly comfortable with that. Interest rates, the global economy, blah, 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 blah. The big thing with these ones is the Fed, what's happening with the Fed, as well as their earnings release. Because they just reported earnings, there's not going to be a ton of volatility from the single stock perspective. Now, from the global economy and from the Fed, that's a different story. But the stock itself, nothing's really going to get released from now until then. So that's something to kind of keep an eye on. It's not, you're not going to have all the answers. You don't have a crystal ball. But that's kind of my starting point. Is I see where it's trading today, where the share price is today, and I immediately look, okay, I'm not even going to look at anything above $175. So $175, you can see here, I've already got some watch, I already have it on a watch list. So I would consider anything under $175. Now you're going to look at this and you're going to see, okay, the delta is incredibly low. The delta is just really low. The implied volatility is pretty low-ish. It's not bad. It depends on the stock. The theta is good. It has a really good theta, but it's not going to work in my benefit in most cases because the premium is so low. Now, if the premium was higher and the theta was high, okay, I'm all for it. But there's really not much room to realize a lot of premium, a lot of income in the next 35 days. And really quick, let me visualize this for you so you can see kind of, what it looks like in terms of how the premium can go down over time. let's look at well, you can see that the last year is just plummeted. Now, this is with time decay. If you did this back in January or let's say December, you are up incredibly. Like you did very, very well. You sold this for $10.95 on December 7th. If you were to buy it back today, you would generate, all of that premium income before the expiration date. So this one, it moves very, very quickly. And, you can see here for 55 cents, that's not really a lot of premium. You can see here in the last 30 days, it lost 97% of its value. 97%. Right now, it's just table scraps. In the last month, it's lost 67% of its value. Just nothing. So for me, this is not interesting. There's nothing left. I don't want scraps. And so maybe that's a bad example. I don't know. But there's really just no meat on the bones. I don't want this. So then what I can say, well, I don't want anything above 175. Well, my only option, I have two options. I can either reach for yield, reach for a higher premium, but then I'm taking on more risk. Well, then I'd have to buy it for $190. But what's my rule of thumb? Well, I want it at least 20% lower. So in this case, I have two options. I can either go at a higher strike price to get a higher premium, but then I'm sacrificing on the share price. Then I'm no longer getting that 20% discount below the current share price. So the risk, let's see here, the risk is I have a higher likelihood of getting assigned, though a delta of 10 is actually really good, by the way. But I don't like it. I want it to be 20% lower. The delta here is just way low. So the payoff, it just doesn't make any sense for me. I just don't want to do that. So I don't want to increase the price. I don't want to increase my risk of getting assigned. So, and because I can't predict the future, I don't know what the market's going to do. I'd be much more comfortable buying it at $175 or less. So my only other option is to either avoid it entirely or push out the expiration date. Well, I can push out the expiration date to, let's say March 28th. On March 28th, what is it looking like for $175? Man, the premium's still just not very good. The premium's not good. The delta's too low. The theta's good. But the theta's not going to help me because there's no meat on the bones, right? It's a weird example, but there's only scraps. So then what I'm going to have to do is, well, if I'm really set on buying, Atlassian, and also it's up today. So whenever the stock is up in the day that you sell these, it will dramatically increase it. So just today, the stock price is up almost 4%, but the option premium is down 28%. That's horrible. So you want to sell these, like we talked about when the fear index is more towards fear and when the share price is down. I don't know. It impacts it. The next thing here is, well, I guess I could push it out. I could buy it for $175. Let's take a look at this. The implied volatility is pretty low. The delta is still pretty low. It's very, very likely, the theta's good. It's very likely that this will expire worthless and I will keep the 180. Now, 180 is just really low. I'm not a big fan of this. I would much rather see this at $4 or $5 so that I could take advantage of the time decay. So if we were to use this real example, let's say if I were to sell 5 contracts at $175 with an expiration date of April 19th, today I would collect $899.85. This is minus the regulatory fees. Okay. So, and then if I were to review that, well, I would need at least $87,500 as collateral in my account. Now, I just don't have that. Like, I don't have it because I'm currently selling other things. And that's not the best return, in my opinion, for that much collateral. Like, that's just a lot of collateral for the time. It's not very valuable to me. It just doesn't make a lot of sense. So I would probably not end up doing this. What I would do is I would probably wait to see and I don't know what's going to happen. I don't have a crystal ball, but I would likely wait to see if I could get this 175 at maybe a $4 or a $5 price. And then I can take advantage of the higher premium. And because we know that it has a higher theta, there's more value in holding something like this, because at such a low bid price, it just doesn't make a lot of sense. And really quick, this is the last thing that I want to show you that I think might be very helpful, is how to calculate how valuable this cash secure put is. And to do this, you're going to want to enter in some things into a spreadsheet. And I'm going to walk you through very quickly how I do it to understand if it's worth your time or not. So we saw the example here with Atlassian on March 15th, 35 days from now. If it was trading at $175 with that strike price, you're going to get a premium of 50 cents. Okay. And because we talked about, I don't want to go, above the $175. If you wanted to go above, obviously you're going to get a higher premium, but it's the likelihood of getting assigned is higher. And I use the same methodology, the same way of thinking with every single stock, regardless of the stock. Okay. That's just kind of as a rule of thumb, how I view this. And because we said that time is money, let's take a look at the, comparison with Atlassian for April 19th, 70 days from now. You can see here that the strike price at $175, you're going to get a premium today of 180. And so what does that look like in terms of percentage of return? Now let's take a look at both of these and compare and see what the annual return would be. So if you're taking a look at Atlassian, if we were to submit this today on February 9th, when I'm recording this video here on Friday, and with an expiration date on March 15th and April 19th, with the same strike price of $175 for one contract with the March expiration date, you're going to get 50 cents per contract. That means you're going to get $50 if you were to do this with one contract. And it's going to expire in 35 days. And this would cost you $17,500. So not chump change. It does cost money. The total return, this is what you're going to want to look at. If you were to do this, you would generate about a 3% annualized return. And how you would generate that, you can pause the video and take a screenshot, but that's how you would calculate the annual return. This is not very good. A 3% annual return is not very good, especially because the tax treatment, this is taxed as a non-qualified distribution. This is not a qualified dividend. So the tax treatment is even worse. So this is not a really, really good return. Now, all things remaining constant, if we were to do this instead of March, but in April, you can see here that we would get a different premium of $1.80. We'd hold it for 70 days and it would cost the same amount of money to do this. You would get an annual return of about 5%. This is better, but in my opinion, this is too low. For something like this, you should at least try to get 7, 8, 10 plus, in my opinion. So if we were to take all of this, and let's say, for example, we were to wait a couple of weeks, and let's say the stock were to revert back down, let's say, something happens. I don't know. This is why you have a list of different stocks, because you're not just doing this on one. You have a list of stocks that you're comfortable doing, and you're tracking which ones make the most sense to do today, okay? But if we were to take a hypothetical and we'd say, okay, we're considering doing this at the same price of $175, but let's say the stock drops 10% from now until, 3 weeks from now. Let's say the stock price, goes down 10%, and let's say this premium goes up to $4 or $4.50, okay? And this would be great, right? And it's not unheard of, because the theta is so high. It's very, very possible that if the stock were to drop 10% in the next couple of weeks, that the theta would jump this premium up. It's very, very possible, very likely actually. But in that case, what would happen is if the contract premium would go up to $4.50, $450 instead of $180, and your annual return would be 13%. This is something where I could absolutely see myself selling and taking advantage of a return like this. So it's very, very important that you just don't go and just sell something just because, but you want to actually calculate what is going to be your annual return if you were to sell an option like this. And regardless of the stock or the time frame, this is what you want to focus on, that you're getting a higher annual return, because this is what it comes down to. You could just throw all your money into SHD and get a 3.5% dividend yield. But if you're selling cash secured puts, your goal should be higher than 3.5%. So this is how I sell cash secured puts for income. This is how I generate a higher return on my capital. So let me quantify this for you and share with you why I'm doing this instead of just investing everything into SHD. So if I were to take all of this money today, invest it into SHD, which is yielding around 3.5%, I'm going to generate about $20,000 a year. This is significantly lower than what I need to pay for my living expenses. That is why I didn't do this, guys. That's why I didn't throw it into SHD. The alternative would be throw it into SHD and go back to work, working my 9 to 5. That's not what I wanted to do. So what I decided to do was, well, you know what? I actually need about $70,000 or $80,000 from this, as just an example. Well, if I were to do that, well, what I'm going to need is about a 12% dividend yield or 12% return on my investment. I'm not going to get there with SHD. I'm not going to get there with SIN stocks. Well, where could I get this? Well, you might be thinking, well, Jake, let's take the SHD, percentage here. And you might be thinking to yourself, well, Jake, you're going to be paying a higher taxes on this. Well, yeah, I'm going to be paying higher taxes, but I'm going to be making a lot more. So you might be thinking, okay, well, what does this look like with taxes? If you to do this with taxes, and the average tax rate is about 15% on a qualified dividend, so my leftover return on a tax bracket of about 15%, after taxes, I'm getting about a 3% return on SCHD. Now you might be thinking, well, Jake, this is a non-qualified, you're going to get taxed much higher. Well, my taxes are not high because I'm in a lower tax bracket, but just, to make it very straightforward, let's say, for example, I'm taxed at a 25% tax bracket, just as an example. It's not going to be that high, but let's just think that it was, or dream that it would be. If I was in a 25% tax bracket, I'm only keeping 3/4 of this distribution. I'm still getting a 9% take-home return if I were to generate $70,000 a year from a strategy like this. It's very possible. It depends on the market and many other factors. But that's my logic and my reasoning behind why I'm doing this instead of just throwing it all into SHD. Now, in a perfect world, I had $2 million and I just threw it into SHD and then I called it a day. But unfortunately, I don't have that. It's not the reality. It's not my reality. And so that's why I'm taking this approach and selling cash secured puts, because my potential for a higher total return, or real return in this case, is higher with selling cash secured puts. It could completely backfire. I could have another year like in 2022 where this completely plummets. That's very possible. And if that's the case, so be it. And that's why this approach is not going to be right for everyone. But for me, that's why I've done this. It's worked out for me so far. If you're interested in learning more about it, you can jump on the phone with me. We can talk about it. But going forward on my channel, I do not plan on talking about cash secured puts in the future. I'm a dividend investor. That's my main focus. Long term, I don't see myself doing this forever. It's kind of a means to an end given my current situation right now. I don't see myself doing this forever. And that's why going forward, I don't plan on talking about this topic anymore. Starting next week, I'm going to go back to my more regular content of talking about dividend investing. So I hope that this video was helpful. I hope it opened your eyes to the complexity, the simplicity, the interesting world of selling options and everything that comes with it. I hope that you'll learn something new, and I'll see everybody in next week's video.
Please subscribe. Please subscribe.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.